Silver at nearly $4,000 per ounce. Sounds delusional, right? That was my first reaction too. When I saw that projection circulating across the financial world, I assumed it was another exaggerated headline designed to grab attention. But instead of dismissing it, I decided to break down the math line by line. Every ratio, every historical comparison, every economic assumption. And what I discovered surprised me. The number itself isn't fantasy. The real debate lies in the assumptions behind it. By the end of this video, you will understand exactly how such a number is calculated, and what I believe is actually realistic. Most investors look at silver the wrong way. They treat it like just another commodity, something that moves based on supply, demand, and short-term speculation. But silver does not exist in isolation. It lives inside a much larger financial system shaped by debt, currency credibility, and long-term economic cycles. Right now, global debt levels are at historic extremes. Government deficits are expanding every year. Central banks continue to rely on monetary expansion whenever markets weaken. And while stock markets have experienced massive growth over the past 2 decades, the structural debt foundation beneath them has become increasingly unstable. Here's the uncomfortable truth. Debt doesn't disappear quietly. Throughout modern financial history, excessive debt has always been resolved in one of 2 ways: through deflationary collapse or through inflationary repricing. Both scenarios dramatically change asset values. Precious metals have historically been the reset valve during these periods, but today, many investors assume that gold and silver are outdated relics. They believe central banks, modern policy tools, and financial engineering have eliminated the need for hard assets. That assumption may be dangerous, because when you analyze long-term historical ratios, especially the relationship between stock markets and gold relative to silver, you start seeing patterns that repeat over and over again. And those patterns suggest we may be at the beginning of another major revaluation cycle. The real problem is not whether silver can rise. The problem is whether investors are prepared for how dramatically it could move if historical patterns reassert themselves. And most people are not prepared. And let me explain why this projection, as extreme as it sounds, deserves serious consideration. There are 3 core pillars behind the thesis. First, the relationship between government debt and gold reserves. Historically, when debt levels become excessive relative to gold holdings, gold eventually reprices upward to restore balance. It has happened before, not once, but multiple times. Second, the long-term ratio between the stock market and gold. This ratio has completed major cycles over the past century. When stocks become historically expensive relative to gold, the ratio eventually reverses, often violently. Third, the gold to silver ratio. Silver consistently outperforms gold during precious metal bull markets. Every major cycle shows the same behavior. Gold leads, silver accelerates. When you combine these 3 forces, you create a mathematical framework that projects very large upside potential. Now, are all assumptions equally realistic? No. Some scenarios assume extreme debt backing levels or historically rare ratio compressions. Others use more moderate expectations that still imply significant upside. What surprised me most is this. Even when you deliberately reduce the assumptions, even when you remove the aggressive scenarios, silver still projects multiples above today's price. Not double, not 20%. Multiples. And this isn't based on hope or hype. It's based on historical ratios that have reverted consistently for over 100 years. The real question isn't whether silver reaches an extreme number. The real question is how much of this historical pattern repeats during the next debt cycle. Because if even part of it does, the move will be far larger than most investors expect. To really understand why some analysts are projecting massive upside for silver, we need to zoom out, way out, and stop thinking in months or even years. This story begins decades ago inside the structure of the global financial system itself. After World War II, the United States emerged as the financial center of the world. The dollar was trusted because it was anchored to gold. Governments, institutions, and citizens believed that behind every dollar stood something tangible. That anchor created discipline. It created limits. Debt could expand, but only within boundaries. Over time, that discipline faded. When the gold standard was officially abandoned in the early 1970s, the global system entered a new era, the era of fiat currency. Money was no longer tied directly to metal reserves. It was tied to policy, to trust, to central bank management. At first, this shift seemed liberating. Governments could stimulate economies without worrying about fixed gold constraints. Credit expanded. Markets grew. Financial innovation exploded. But something else expanded too. Debt. Every recession was met with stimulus. Every crisis was met with liquidity. Every slowdown was met with lower interest rates. Debt stopped being a temporary tool and became a permanent feature of the system. Decade after decade, borrowing accelerated faster than real economic growth. Now, here's the key point most people miss. Debt doesn't matter until it does. For long stretches of time, expanding debt appears manageable. Asset prices rise, confidence holds, currencies remain stable. But beneath the surface, pressure builds. And historically, when that pressure reaches critical levels, the system rebalances. There are only a few ways it can rebalance. One path is deflation. Asset prices collapse, debts default, and leverage is purged. That happened during the Great Depression. It was brutal. Paper wealth evaporated. Banks failed. But after the pain, debt levels reset. The other path is inflation. Currencies lose purchasing power and the real value of debt shrinks over time. That's what happened during the 1970s. Instead of defaults wiping out debt, inflation diluted it. In both scenarios, one asset class consistently responded in dramatic fashion: precious metals. Gold surged during the inflationary 1970s because it became a refuge from currency debasement. Silver followed, but with even greater volatility. When gold confirmed the trend, silver accelerated it. Why? Because silver sits at the intersection of money and industry. It is not purely monetary like gold, and it is not purely industrial like copper. It occupies a hybrid role. When monetary fear rises, investors buy it. When economic expansion demands industrial materials, manufacturers consume it. During powerful macro cycles, those two demand streams can align. Now let's connect this to today. Global debt levels are not just high, they are historically extreme relative to economic output. Governments continue to run deficits even during expansionary periods. Central banks remain highly sensitive to market volatility, often stepping in with liquidity when stress appears. At the same time, equity markets have delivered enormous gains over the past 2 decades. Technology booms, easy credit, and low interest rates have pushed valuations upward. But when you measure stock market value relative to gold, a different story emerges. There's a long-term ratio that compares stock indices to gold prices. Across a century of data, that ratio moves in waves. Stocks outperform gold for years, sometimes decades. Then, eventually, the cycle reverses, and gold dramatically outperforms stocks. The peaks in that ratio occurred before major economic resets, 1929, the late 1960s, and around the tech bubble era. Each time, the reversal phase lasted years, not weeks, not months, years. During those reversal phases, gold didn't just rise slightly, it repriced significantly relative to financial assets. And silver? It typically outpaced gold once momentum built. Here's another important layer. Mining supply is not elastic in the short term. Bringing a new silver mine online takes years of exploration, permitting, financing, and construction. Even expanding existing production is a slow, capital-intensive process. That means when demand surges suddenly, especially investment demand, supply cannot instantly respond. This creates periods where price must rise to ration available material. Now combine that with modern industrial demand. Silver is essential in solar panels, electronics, electric vehicles, medical technologies, and advanced military systems. As global electrification expands and renewable infrastructure grows, silver demand from industry continues to increase structurally. This creates a unique scenario. If monetary uncertainty rises at the same time, industrial demand remains strong, silver could face dual pressure from both sides. Some argue that higher prices will solve any supply deficit. Eventually, yes. But history shows that during major bull markets, price increases do not immediately stabilize supply-demand imbalances. The response, L, the 1970s provide a powerful example. Gold rose more than 20-fold. Silver delivered similar magnitude gains. Mining output did increase, but it did not prevent the rally. The macroeconomic forces were stronger than the supply response. Now consider where we stand today. Debt remains elevated. Currency purchasing power continues gradual erosion. Equity valuations remain historically stretched relative to hard assets. It is about the tension between expanding debt and finite tangible assets. And most importantly, it is about understanding that major financial adjustments do not occur gradually and politely. They build quietly for years. Then they move. And when they move, they rarely give everyone time to prepare. That is the historical backdrop behind the silver thesis. Not excitement, not speculation, but a long, slow financial pressure that may once again demand repricing. Now let's bring everything together and talk real numbers. After walking through the debt dynamics, the stock-to-gold ratio, and the gold-to-silver relationship, the big question becomes simple. What does this actually imply for silver? First, understand something clearly. Extreme projections only happen when extreme assumptions are stacked together. If you assume maximum debt backing levels and the most aggressive historical ratio compression at the same time, you get explosive numbers. But that combination represents a ceiling scenario, not a base case. So let's remove the extremes. Instead of assuming a full historical reset in debt backing, imagine a partial repricing. Instead of assuming the stock market collapses relative to gold to the absolute bottom of past cycles, assume it only moves halfway. Instead of assuming the gold to silver ratio compresses to rare historical lows, assume it compresses into the more common bull market range. When you run those moderate assumptions, something surprising happens. Silver still projects several multiples above its current price. Not a small gain, not incremental appreciation, multiples. Here's why. Historically, when the stock to gold ratio begins compressing after long expansion cycles, gold tends to outperform equities for years. That does not require stocks to crash dramatically. Sometimes stocks simply move sideways while gold rises. That alone can cut the ratio significantly. If gold experiences a strong multi-year repricing cycle similar to past debt stress environments, and silver behaves the way it historically behaves during precious metal bull markets, meaning it outperforms gold as the cycle matures, then silver as upside becomes structurally amplified. Even using conservative gold to silver ratio assumptions, levels seen during normal bull markets without speculative extremes, the implied silver price becomes dramatically higher than today. And this is the key insight. You do not need a financial apocalypse. You do not need a return to a strict gold standard. You do not need central banks to suddenly announce silver reserves. You only need historical behavior to partially repeat. Throughout modern history, excessive debt cycles have ended with asset repricing. In some cases, inflation diluted debt. In others, deflation reset valuations. In both environments, precious metals ultimately benefited once the dust settled. Now consider the present structure. Global debt remains elevated. Fiscal discipline is politically difficult. Monetary policy is reactive rather than restrictive over long cycles. Meanwhile, precious metals still represent a tiny allocation within global portfolios. That imbalance creates asymmetry. Could the thesis fail? Yes. If governments somehow stabilize debt without triggering inflation or recession, the urgency for repricing weakens. If a severe liquidity crisis hits, metals could temporarily fall alongside other assets. If technology dramatically reduces industrial silver demand, part of the supply-demand pressure eases. These risks are real, but what makes the thesis compelling is probability stacking. Two major long-term ratios, stocks relative to gold and gold relative to silver, are both elevated compared to historical compression zones. In previous cycles, both eventually reverted. If they revert again, even moderately, silver ES move does not need to be extreme to be transformational. The most aggressive projection may grab headlines, but the moderate projection is the one that deserves attention, because moderate historical reversion alone implies a powerful multi-year move. And if history rhymes even halfway, silver's biggest gains are not behind us, they are ahead. Now, I want to hear from you. After seeing the debt trends, the long-term ratio cycles, and the historical behavior of gold and silver, where do you stand? Do you believe we're heading into another major repricing phase? Or do you think this time truly is different? Because here's the reality. Markets are driven by probabilities, not certainty. No one knows the exact number. No one can predict the precise year. But we can study patterns, and the patterns right now are hard to ignore. So let me ask you directly. If gold continues to outperform stocks over the next decade, and if the gold to silver ratio compresses the way it has in past bull markets, what price range for silver feels realistic to you? 400, 600, higher? Or do you believe supply growth and industrial limits will cap the upside? Drop your target in the comments, and more importantly, explain your reasoning. I'm especially interested in hearing thoughtful counterarguments. Strong debates sharpen strong ideas. If you found this breakdown valuable, share it with someone who thinks large silver projections are pure fantasy. Show them the logic. Let them decide. Because the conversation matters. And sometimes the smartest move in markets starts with asking better questions. Let me leave you with this thought. Throughout modern financial history, whenever debt expands beyond sustainable levels, the system eventually forces a reset. It doesn't happen overnight. It builds slowly, quietly, often while most people are distracted by short-term market noise. But eventually, pressure demands release. Right now, two long-term ratios sit far from their historical equilibrium levels. Stocks relative to gold and gold relative to silver. In every previous cycle, both ratios eventually reverted. Not perfectly, not instantly, but decisively. That doesn't mean tomorrow, it means unfinished business. If those ratios compress even halfway toward prior cycle lows, silver does not need extreme assumptions to move dramatically higher. It simply needs history to rhyme. The loudest number grabs attention, but the quiet math behind moderate scenarios is what truly matters. Because once repricing begins, it rarely waits for consensus. By the time headlines declare it obvious, the biggest percentage gains are already gone. So the real question isn't whether silver can reach a specific headline target. The real question is whether we recognize structural shifts before they become mainstream. Cycles don't last forever, and when they turn, they don't ask for permission. History has repeated this pattern for over a century. The only question now is whether this time will be any different.